Hello and welcome to this special program. I'm sitting down with someone who needs no introduction. He is the most powerful banker in the world, the biggest by far. He's also one of the most recognizable American businessmen in the world. Jamie Dimon is CEO at JPMorgan Chase. Mr. Dimon, great to have you with us here. Thank you very much for your time.
Prashant, thrilled to be here.
How does it feel to be back here?
It's wonderful. I mean, when you get out, you meet your own people and the clients, and I was mentioning before, we've gone, since I've been here, we've gone from 6,000 employees here to 60,000. And they're across all things, data, scientists, engineering. We cover 150 companies in research and banking, 850 multinationals come in here, custody, asset management. We've just been growing with the country, and your country's been growing quite well, and I'm quite optimistic about the future of India.
And markets have been booming as well.
Markets, yeah.
I'm going to get to markets in a bit, but I just want to start with the first bit, which news which just came out, a government-to-government deal between US and India to set up a semiconductor fab unit in the country.
Right.
There are elements of technology transfer, etc. That's the cutting edge, semiconductor, and sort of plans to localize production. I just wanted your thoughts.
I think it's great. Look, I would love to, India's quote a non-aligned nation, and I don't think we should be asking to align, but I think it's great that we're reaching out to each other, helping each other, investing in each other, and I would love to see far more of that. And this has two elements. One is the national security part, which of course all countries have interest in. And the second is just, a better economic relationship.
Over the last 2-3 years, we've seen the rise of the so-called industrial policy across the world. Yeah. National security is being prioritized, as you've said. Do you see this as part of that, in the context of that?
Yeah. So industrial policy, I'm a little cautious about. I think to combat some of these things and to do things in your country's own interest, which are hard to do economically, you're going to need some economic policy, industrial policy, like the United States has, for rare earths and things like that, and lithium. Every country is different. So the national security needs of India are going to be more around energy. I think for everybody, it's going to be semiconductor chips. So I do think that's industrial policy. I would caution industrial policy when it's used for regulations, bureaucracy, politics, votes, social, and it doesn't have, the twin of permitting. It's not going to work. So you got to be a little cautious when you use it. But yeah, we're going to have some. And like I said, I think it's very important that America and India have a great economic relationship.
Would you agree, though, that in the former part of what you described, industrial policy is kind of taking the lead. Businesses and who you align with, who you want to do business with, building supply chains. A lot of that is now, it seemingly is led by that. I mean, what governments really want to do.
Well, no, it's two different. Governments have always negotiated economic arrangements, stuff like that. If you look at the United States, the industrial policy is a very teeny part of the economy. So it isn't like it's taking over the economy. Right. I think in other parts of the world, it's obviously a much bigger part of the economy. So, but yeah, nations, because of national security, and because of what some people might consider unfair competition, there will be forms of industrial policy. If I was a government, I'd be very, very careful. It should be very targeted, very specific. It shouldn't be to protect local industry. It shouldn't be to just create jobs. It should be for a very specific reason. But you're going to see it, and hopefully it's well done.
U.S. has been trying to reduce its dependence on China. India has been and is expected to be a big beneficiary of it. Do you think we are sort of using that full potential right now, or there's a long distance to go?
Well, look, going to China, okay, national security, America was overly reliant. That's not being angry at them. You should ask why we didn't do it before, but in terms of rare earths, semiconductors, penicillin, ingredients for pharmaceuticals, obviously every nation look at it and say, we can't rely on someone who might one day be an adversary, that doesn't make them an adversary today, for supply. Just like JPMorgan always have multiple diverse supply chains, we don't rely on anything. The second one is around disagreements around policy, like if countries are aiding and abetting industries to dominate global industry and beggar thy neighbor, well, that's not going to work either. So you're going to have people, they're going to be hard fought. It's not going to cause deglobalization, but it's important that countries do that. And so, and it's just starting. It would take years. The semiconductor, you're talking about 5, 10, 15 years. So even if it's going to take place, it's going to take a long time. But companies are doing it on things like iPhone. I know iPhone production. So some things can move quick. Some will take years. Huge opportunity for China. I mean, for India. A huge opportunity for India. People call it the China plus one strategy now, that companies that relied solely on China are going to look at India, Vietnam, Malaysia, Indonesia, et cetera.
We've got US elections, and I think one thing which both Democrats and Republicans agree on is China. You'd agree with that? I mean, in that sense, what's happening is in a way irreversible? The break in relations, sort of a Cold War?
I think you have to be very specific in this one. I think national security, everyone's going to do. Unfair trade, everyone's going to do. I think because of the Ukraine, the terrorism in Israel, Russia, Iran aiding and abetting, China's kind of on the other side of America now. So that's causing a lot of the tension. I think the better thing to do is get fully engaged, which they've done, our government, to try to protect ourselves in national security, unfair trade. And yeah, I think if the war goes on, yeah, there will be contentious issues between far more contentious because of that. So both sides, I think, will be fully engaged. Both sides are going to be tough, but I don't think either side is talking about disconnecting.
What can India do, Mr. Dimon, to attract more FDI, foreign direct investment? The conditions are ripe, as you said, the economy is doing very well, markets are booming. What else can we do to accelerate this process?
I think, first of all, you've done a lot. The Prime Minister, that odd par program, I think I'm saying that right, the change in the GST, the tax system among the states, national infrastructure, your schools graduating a lot of extremely bright, talented people. Those are the things to do. Reduce regulations. Here, regulation bureaucracy does cripple foreign direct investment. So make it easier for foreign direct investment to come here. And then you have to do industry by industry. But I do think you should be attracting it. It'll help you grow much faster.
Let's talk about the big event from last week, which is interest rates coming down, the Fed cutting by 50 basis points. Do you think it was a bit excessive, given the fact that GDP is expected to grow at 3%, the stock markets are at all-time highs? I mean, there's no issue with credit spreads, etc. Indicators are all pretty good, and you get a 50 basis point cut. What did you make of it?
I think it's a lot more ink than it deserves. I think they raised rates to 5 very quickly. They were a little late, which they acknowledged. They raised it to 5. The economy is slowing down, inflation is coming down, and relative to inflation, even if inflation is 3%, the 5 is maybe a little bit too high. So they made a big step to get it close to what they think it might be. They've got plenty of room to go down, and hopefully we'll continue to exhibit growth with inflation coming down. I'm a little more skeptical than other people about that, but it is happening, and they're just reflecting reality.
You've been cautious in the past about prospects and said, well, one has to be prepared for things going wrong. Are you a little more positive now? I mean, this is not a cut when you're facing a recession or things are looking weak. It's like a happy cut. So, I mean, are you a little more...
I'm not. So my caution is all geopolitics, which may determine the state of the economy.
Okay.
But it's really the geopolitics that these things, they're getting worse, they're not getting better. There's chance for accidents in energy supply. God knows other countries getting involved. You have a lot of war taking place right now. You have American warships being attacked almost every day in the Red Seas. That's my biggest caution. The economy fluctuates. I don't worry that much about the fluctuation of the economy. And obviously the Federal Reserve will try to do its job to moderate the vicissitudes of the economy, but we are spending a lot of money. And in my view, that spending the money causes growth, it also causes inflation, and whether it all moderates, I think it's true for countries around the world. We got to really think through how much debt countries can put on before it causes a real problem. So I'm long-term optimist. Short run, I'm a little more skeptical than other people that everything's going to be great. Markets are pricing things like they're going to be great. I'm put me on the cautious side of that one.
Right. I mean, rising interest rates did not hurt markets. Will falling interest rates be an impetus? I mean, can there be a further impetus?
Yeah. Again, so when you talk about rising, things are, sometimes history rhymes, but it's not always the same. I think when rates went from 0 to 2.5, that was barely rising rates. That's just kind of normalization. And we had very strong growth coming out of COVID. So, 5% was probably needed to slow things down just a little bit. Yeah. Underneath the rate, there's a real economy. No one knows what that real economy is going to do next year. No one. And so I don't look at it like, they're panicking to, maybe the economy's get stronger, maybe it's going to get weaker. And so they're trying to remember they're reacting to data they see today. And then you can try to predict what the data is going to be a year from now. I think there's more underlying inflation because of things like the green economy, fiscal spending, remilitarization of the world, demographics. Those things will drive inflation down the road. And even AI, in my view, right now it's a little inflationary because we're all adding a lot of talent around data. It's not, the deflationary part may happen, but that may be several years down the road. Yeah.
Right. You are, when you say you are a bit more skeptical, is that the economy you're skeptical about, or markets and what they're pricing in?
Both.
Both.
I think the stock markets and the bond markets are pricing in a soft landing.
Okay.
But you also look at the stock markets are generally very high, and bond spreads are very low, and that's kind of Goldilocks, and that may very well happen. I mean, I'm hoping for that. I just give it a lower odds than the market does.
Of that happening.
Yeah.
You said geopolitics is still the biggest worry for you. Who in the White House in the next 2 months is best placed to end the war in Ukraine, Russia-Ukraine?
I don't think it can be ended in the next 2 months. I think it's getting worse, and look, I'm sure the Biden administration, I have tremendous respect for Anthony Blinken and Jake Sullivan. I think they're doing the best they can. But remember, there are adversaries. There are other people. This is not a unilateral action America can take, and that America's got some tough decisions to make, just like Europe. And so I think the allies need to really get prepared for a longer war, more military, unfortunately more military, help the Ukrainians. And then that is the only thing that will eventually lead to some kind of peace or armistice in Ukraine's interest.
Are you throwing your weight behind? I mean, people listen to you. People look at what you say. Who are you supporting, if I can put it bluntly?
I'm not endorsing anyone at this time.
Okay.
I spend more of my time on policy. What's the policy we need that can really help both the world, that's foreign policy, and domestically?
Right.
And I would have a negative income tax. I would have better permitting. I would reduce certain regulations. I would love schools to judge themselves on when the kids, high schools and community college, when they graduate, what kind of job do they get? And so you're focusing on the outcome, not just the input. And so I think there are a lot of things to do to make America healthier and to lift up all of our citizens. I think we've, if you look at the data, we've left behind the bottom 20%. Yeah, we should focus on that. That is a legitimate thing for a government to say, why is that? They're also dying younger, their schools are worse, they have more crime in the neighborhoods, and that's kind of why you have populism. And so I think we need to do a lot just in America to lift up our country, and as we do that, it helps the rest of the world.
I mean, there's been a talk that if Mr. Trump, and in an interview he said this, that he may tap you to be the Treasury Secretary, Mr. Dimon. I just wanted to ask you this.
He said like, the next day, definitely not. So I don't expect to be the Treasury Secretary.
Well, there's Mr. Musk, who's also been sort of, he said openly that, well, I'd love to be part of a Trump administration. I just wanted...
Okay, so Elon, this idea about having an efficiency commission, I actually like the idea. I mean, I think governments have to become more efficient, more competent, and look at, when they take money, what do they get for it?
Right.
And I actually think it's a very good idea. It's kind of like, remember Al Gore had the reinventing government? Right. We really need to do it. And in America, we need to do it. I'm sure a lot of the countries need to do the same thing.
Right. Do you think under a Trump presidency, I mean, one of the big things which we all talk about, and he said many times, is tariffs essentially go up all the way, quite a bit, especially with China, but matching tariffs for all trading partners. Do you think that's a likely scenario?
I don't know the answer to that. I've spoken to some of his top advisors, and actually I was in D.C. last week, and they say, yeah, it's more of a negotiating tactic than an expected outcome. Remember, they did negotiate USMCA, they did negotiate with China, a couple whole trade agreement with China. So yeah, I think the tactic would be rolled out. I would prefer we just end up with better trade deals.
Got that. Let's talk about JPMorgan and you, Mr. Dimon. What are JPMorgan's plans here in India? I mean, you've been here a long time. You're growing fast in this economy. Yeah. Tell us a little bit about what your plans are.
I've already mentioned how much we've grown here since I've been coming here, and I think that'll continue for the next 30 years. And so, you have some wonderful industries, some great technology. You have great schools, and those building infra. Those are the things which will drive it. So, and we are just a cog in that machine. We take that research we do and we take it around the world. We take your Indian companies around the world and help them raise money in America and parts of Asia. We bring in a lot of multinationals, and we're expanding what we cover. We're doing more of what I call commercial banking here, like smaller companies, et cetera. So I think that'll continue for as far as we can see.
And we got so many foreign companies who want to list here in the public markets. Yeah. I mean, Korean companies, American companies, and you think, you have a bird's eye view of what's going on. You think we'll see more and more of that?
People list is affected by multiple different things. So, but I think, if you do the right things here, yes.
I mean, when you speak with investors and sort of other some of your peers, what are the 2 or 3 things that you hear about India right now? Because, it's been kind of unreal in a good way, how well the markets are doing. What do you hear about India's feedback? I must point out that foreigners have not been big buyers of Indian stock in 2024 or 2023. It's a local-driven sort of market. Will that change? What do you hear?
Well, I was just speaking to. I mean, I've just got here, so you're asking me questions that. One of the reasons I travel a lot is I get to learn a lot and be more up to date. But a company that did go public here told me that 40% of what was bought was international, so it was not. It was like, American money managers, mutual funds, et cetera. So, yeah, I think the markets will grow over time. India, because India's going to grow, and India's doing a lot of the right things. I would say just continue doing the right things and continue to attack that bureaucracy. And the biggest complaints I ever get about bureaucracy, regulations, not dissimilar in my own country, but continue to attack that. Make it easier for foreign direct investments to come in, and yes, you will grow and expand and have bigger markets here.
Mr. Dimon, a quick last word about what your plans are. I mean, that's the other bit which, I mean, you're one of the last rock star bankers, if I can put it that way. And I'm not exaggerating. I just wanted to ask you that.
I'm getting old, basically. I love my job. I literally love doing it. I can help our employees and our clients, and I think it lifts up countries, and we finance schools and states and hospitals and governments and big companies and small companies, and then we have policies to lift up part of society that needs a little bit of help. Yep. I love it. And eventually I'll leave. We've got great successors. We've got built-in successors. Yeah. If you ask the analyst community, they can point 4 or 5 people they think are quite capable. And so sometime down the road, some of those people move up, and maybe I'll go to chairman for a while, something like that. And when I do, I'll miss it. Mr.
Dimon, I hope you continue to run things for a while. Thank you so much for sitting down with us here.
Prashant,
really
thank you very much, folks. Thank you.
Thank you so much.
Here, James, it's such a pleasure to be here with you in person, and thank you for making time for us. And we talk at a very interesting time, right? Because we have global markets at all-time highs, and now you have the central banks increasing the music, whether it's the Fed or the PBOC overnight. Can the party continue?
Thank you very much for having me. It's great to be back here in Mumbai. Look, I think that the critical element to think about from an Indian market perspective is the degree to which market performance for the past couple of years has been really a DIY story. If I look at flow of funds, it's been almost entirely domestic investors that have driven this market, and yet that still has further to go. If I look at domestic household participation in the equity market, we're only at about 5 to 6% of Indian households, which is low for most emerging markets. So again, more runway from here. If I look at foreign investors, you're still looking at foreign investors dramatically underweight this market and falling farther behind as the market continues to perform. The JPMorgan estimate is that we need to see about $100 billion in incremental inflows into Indian markets for institutional investors to just get to neutral.
Wait, let me come in over there. $100 billion of inflows.
That's correct.
Just to get to neutral weight.
Correct.
And do you really see that kind of money coming in, and over what time? And then what happens to valuations in India?
So year to date, you've only seen about $10 billion in inflows, so an incremental $90 billion to go. And then incrementally, we need to look at sector and stock selection to understand where that's going to go. We still see a very strong earnings growth story coming out of specific sectors within the Indian economy, in particular infrastructure, construction, as we start to look at supply chain relocation, which has not yet occurred coming into this market. So again, going back to this theme of market performance and economic performance has been very DIY in nature. It's been Indian corporates driving CapEx, not FDI coming into India from offshore. As that starts to occur, you still have significant incremental economic growth and therefore earnings growth, which makes valuations significantly more palatable.
Let me just quickly hand it to my colleagues back in the studios. They have some questions as well. Prashant, over to you.
Surabhi, thanks very much for that. That's a big number, right? $100 billion to get up to sort of neutral weight. James, one of the things we've heard sort of repeated again and again when we speak with investors, foreign investors, etc., is that this underweight may remain because valuations remain very high, and foreigners kind of feel left out, and they don't really want to chase stocks higher because that's what they have to do. I mean, it's a very different situation if they came in size a year ago or a year and a half ago. Do you think eventually, I mean, people will just throw in the towel and they'll have to just get in, or it's possible that they stay out for a while longer? What's your sense?
No, thank you for that. I think there's 2 different criteria that I'd be looking at, particularly from a foreign investor perspective. Number one, earnings incrementally have to come through. First quarter was a little bit on the slow side. JPMorgan estimates is that you'll see a re-acceleration in certain sectors, but not the overall market as a whole. And so again, very clear stock and selection bias rather than just broad asset allocation into the Indian market. The other reality, if I'm looking at it from a foreign investor's perspective, however, is tracking error relative to my benchmark. The degree to which India market outperformance continues to accelerate and I'm underweight, I'm seeing more and more drag on my overall performance numbers. So you could start to see investors try and square those positions as we come into year end. It's also just very interesting from an investor psychology perspective. Most investors will close out their books at the end of this calendar year. You effectively get a new risk budget on January 1st. That does drive many investors to start to more aggressively change their asset allocation across countries and sectors off the back of that fresh risk budget.
James, just, you do mention the state elections which are lined up, right? So apart from valuations, do you think politics is a determinant for how investors will view the Indian market in terms of policy direction, etc.? We've had a substantial increase in handouts, or at least talk of handouts, across elections which have happened over the last 1.5 years or so. And, once you roll these out, it's very difficult to take it back. You can only expand on it. That's essentially the experience. What is your sense? I mean, could that be a trigger? And is that a risk to watch out for?
No, it's a great question, and I would approach it from at least two, if not three different directions. Number one, from a macro geopolitical risk perspective, it's important to understand the degree of risk premia built into markets. Given valuations here in India, there are not significant risk premia built in, which is important for investors to keep in the back of their minds. There's not a lot of wiggle room in the price from a geopolitical risk perspective. Now, that said, from a policy perspective, we've seen relatively clear policy goals out of the national government here in India. We've seen very clear and effective implementation across a lot of those goals over the course of the last couple of years, which is clearly investor expectation moving forward. I would highlight that the recent election here in India, as you say, has resulted in slightly more income redistributive policies coming out of the central government. At the end of the day, given the nature of Indian economic development, and Sajid Chinoy, who's our chief Indian economist, talks about this quite a lot, there's been this concept of this K-shaped economic recovery. Dealing with the bottom leg of that K is absolutely critical for economic growth, particularly on the consumption side in India. And so the fact that we are seeing government policies more proactively address that bottom leg of the K, that's actually very important for economic growth as well as political stability here in India.
Okay. All right, James, just some more questions before we let you go. So now that it's been established that there is more money coming in India and maybe foreigners are going to play catch up sooner rather than later, I think the question that people are grappling with is what to buy in India. We've had this phenomenal PSU move, state-run companies, their move play out. Those stocks are off their peaks. But do you think that's where people will go back and gravitate in? Is it still going to be manufacturing or capex? Or will there be a return to, say, consumer staples or even banks, which haven't done that well in the recent past?
I think one of the consistent refrains that we talk about at JPMorgan and we hear back from many, in particular foreign investors in Asia, is really trying to understand where government policy is going to inflect different areas of economic growth. We're seeing that very clearly in China, where investors are trying to follow government pronouncements and follow different favored sectors in the Chinese economy. Here in India, we see significant incremental government capex in infrastructure in particular. Again, that's been almost entirely Indian government as well as Indian corporate-led. We have yet to see that influx of FDI into supply chain relocation, which we do incrementally expect as well. So industrials, infrastructure are our favored sectors. We would also highlight from a regional perspective, we talked about geopolitical risk earlier in the conversation. We are seeing very strong performance out of defense stocks in almost all countries in Asia, Japan, Korea, here in India, where you've seen very, very strong performance for some of the names from a bottom-up perspective. And as the Indian government continues to seek to diversify its suppliers in that space, we would expect to see continued sector performance.
All right, so still optimistic on some of those themes that have done really well in the last year and a half over here. Final question, James, what would be the biggest risk for this market, for India?
I think if we start to see significant policy questions moving forward, the critical element of India really over the course of the past two administrations has been policy clarity and very effective implementation of policy. If you look at Aadhaar, if you look at direct payments to citizens, if you look at a lot of the different macroeconomic policies that this current administration has pushed forward, that's been a clear driver of not only economic performance, but also drag on market performance. As we start to look forward, any shift in terms of policy certainty, any shift in terms of an investor's ability to understand what are the goals of the Indian central government introduces risk in forecasting. Risk has a price.
Okay, all right. So as long as policy continues to move at the pace that it has, and if there's stability and continuity, we're getting $100 billion in inflows in all probability, right? That's the big headline. Thank you so much for joining us today. Pleasure having you right here with us, and this conversation very, very helpful. Thank you very much.
Thank you.